Hi, I'm Jim Jubak for Jubak Asset Management. This is the JubakAM.com video for November 20th, 2018. Even great growth stocks, and I put Amazon and Alibaba in that category, slow down from time to time. It's only logical, because not all growth opportunities are equally easy to exploit. Some require more capital investment, come with lower margins, at least initially, and face more competitors that have to be vanquished. Off with their heads! Both Amazon and Alibaba find themselves facing very similar challenges as they seek to move from their very profitable home markets and expand into new overseas opportunities. For example, Amazon has targeted India as a big next market. Makes sense. India is a huge economy with a retail sector that's made up mostly of smaller players. This sector is ripe for consolidation by a big player such as Amazon that can make navigating India's notoriously inefficient logistical network just a bit easier for consumers and for companies selling through Amazon's marketplace. But it would be insane to imagine this growth will be easy or inexpensive to bag. To take one instance, yes, India's chaotic transportation system gives a company that can bring improved logistics to bear a huge competitive edge. But putting that logistical expertise to work requires lots of investments in warehouses, fulfillment centers, transportation networks, and the like. And in the meantime, Amazon has to fend off both native Indian retailers, who not surprisingly want to hang on to their sales, and international competitors such as Walmart, who see the same opportunities in India as Amazon does. All of which means that Amazon's sales growth in India will take a while to hit its stride, and that those sales will initially be less profitable than in a market such as the United States, whereas Amazon has already made those investments. Alibaba faces similar challenges in growing its business in the Southeast Asia markets it has targeted. High-growth companies always face a challenge when they look at new growth opportunities. They seldom come with the same profit margins as the company's historical growth markets. That means that an Amazon, like Microsoft before it in the age when it dominated the box software market, to take one example, faces the potential for a period of stock market softness because profit margins are likely to fall and costs are likely to rise. I'd argue that Microsoft, where I worked for almost 12 years, faced that challenge and floundered in its initial response to the software as subscription model. Amazon and Alibaba seem to have decided to take the short-term hit and go for the long-term growth. That's not going to be a comfortable decision for investors in the short term, even though I believe it's the right decision in the long term. After all, Amazon trades at 124 times trailing 12-month earnings. This has been Jim Jubak for Jubak Asset Management Video.